A lot of banks, a lot of institutions are sitting on this powder keg right now, hoping that people don't know just how close they are to seeing their own financial institution, their own deposits blow up. Not at all am I surprised by this. Not at all. All right, top story of the day. Republic First seizure signals more bank failures to come. Experts are warning. Fears of contagion reignited by the first bank failure of 2024. Not at all am I surprised by this. Not at all. So I have the immense pleasure of consulting with many financial institutions, and so many of them are on borrowed time. They're on borrowed time because they have loaded up their balance sheets with so many investments that are long dated in duration. And as rates continue to climb, those investments that they put on when rates were basically near zero are losing value day after day after day. And if we actually do see rate increases, which is now on the board because inflation is not coming down, if we do see those rate increases happen, their investments are going to go down even more. Right? A lot of these investments are already worth 80 cents on the dollar, 70 cents on the dollar. And if they go down even more, we could be looking at 60 cents on the dollar. Now, if you're holding that to maturity, like if you're planning to just hold it until you get your investment back, that's not necessarily a big deal. The problem comes when depositors need their funds, and your custodian, you the custodian of those funds, have put those funds to work in loans and investments. You're not going to be able to claw the loan money back, right? You're not going to be able to take someone's car and then resell that and get that loan money back. So what you'd have to do is liquidate your investments. And if you have to liquidate your investments on $1 billion of investments, and you're only going to get $600 million back, that's a huge, huge problem, and something that a lot of banks are sitting on. A lot of banks, a lot of institutions are sitting on this powder keg right now, hoping that people don't know just how close they are to seeing their own financial institution, their own deposits blow up. Thankfully, we do have the FDIC, but that only covers up to $250,000. And if your bank has lots and lots and lots of accounts that are greater than $250,000 and they need to pay back those depositors, we're going to see a lot of problems really quick. And I don't know exactly what's going on with First Republic. We're going to look at it together, or Republic First. But I'm going to tell you right now that this is something that's going on pervasive in the industry. Republic First Bank, a regional lender out of Philadelphia, has become the first bank failure of 2024 on Friday. It was shut down by Pennsylvania's bank regulator and the FDIC. The FDIC quickly made a deal for Fulton Bank to take Republic First assets, but one expert in the financial regulatory reform and bank failure says the collapse could be a harbinger of things to come. I've been saying this for a while. This doesn't surprise me, because so many institutions have levered into these long duration investments. And those long duration investments at 3% are getting less and less valuable every day. And if rates go up even more, this is going to be widespread. If rates go up even more, it's going to be widespread. This bank failure indicates additional failures will occur and will range between smaller community banks and larger banks. The cause is twofold: higher cost deposits, right? So if you put your money into an institution, you used to be able to get, 5 basis points on your savings account, for example. Now I'm seeing savings accounts being advertised for 3.5%, right? 350 basis points versus 5 basis points, significantly higher, right? So higher cost of deposits. I don't think that is necessarily the issue here, but the low yield treasury securities and similar investments held by bank. That is the problem. That is the problem right there. Because when they go to withdraw those deposits, withdraw those investments, to cash out those investments, to fund those depositors who are taking their money out, and they can only get 60 cents on the dollar, that's not good. Right? You no longer have $1 billion institution. You now have a $600 million institution. And if wind of these shortfalls gets out into the marketplace, you will have runs on banks, and those banks are toast. They will not be able to satisfy all the depositor demands. And I mean, they can't already right now because of fractional reserve banking. Don't actually have all that much cash on hand. And what they could liquidate out of investments, they might get 60 cents on the dollar. And then they've still got a big portion of their book that are in loans that they're not going to be able to liquidate. So if this is starting to happen, I think it's going to be a domino effect, and it's going to be brutal. Regional banks have been struggling to retain deposits as customers seek the safety of larger, too big to fail rivals. And higher interest rates have diminished the value of their loan books. Okay, so same thing with investments, right? If you made a mortgage, like my mortgage is around like 3.5%. If I want to get a new mortgage today, it's probably 7%, maybe even more. My mortgage is worth less to the institution because they earn less on it. So because of that, if they were to sell my mortgage to another institution, they wouldn't get 100% of value. They may only get 70% of value. They may only get 80% of value. Because out in the marketplace, they can go get a new mortgage today at twice the rate as what my mortgage cost. Does that make sense? Right? This is all banking theory here. I love this stuff. I nerd out on this. I do nerd out on this all day, every day. Regional banks have been struggling to retain deposits as customers seek safety. Right. We talked about that. And the loan books could have unrealized losses and lower commercial real estate values. Oh my gosh. There are some institutions that are so freaking hosed. I know one in particular that has put on tens of millions of dollars in commercial real estate that there's a high likelihood they may never see that money again, because commercial real estate is a bottomless pit right now. Everybody's still working from home. The whole marketplace for commercial real estate has completely changed in the last few years. And because of that, anybody who's owning commercial real estate could be in huge trouble. Investors have worried about a possible contagion in the sector since three prominent lenders, Silicon Valley Bank, First Republic Bank, and Signature Bank, collapsed in 2023, which is exactly what happened to them. It's just happening now. New York Community Bank fell under pressure, was able to raise $1 billion last month from investors. I would not be one of those investors. The collapse of Republic First Bank has reignited fears of contagion. So let's take a look at Citibank, right? Taking a look at Citibank inside of Outlier here. We actually got a buy signal in Citibank. And, you know, that kind of fits with the narrative here, right? The too big to fail banks, getting a buy signal to go along with that. More people are going to be looking for these type of banks. More people are going to be looking to put their funds into somewhere where the government, as they have seen in the past and may see in the future, can come and bail them out easily. And that's not places like Republic First Bank or First Republic Bank or any other Republican First combination kind of a bank. And so Citibank may be the place where investors are going to, which may be why we got a buy signal here inside of Outlier. And in fact, if you look at it, we actually have a 16.99% return, not too shabby, 17% return in Outlier. But the buy and hold for Citibank is down negative 20%. Right. So you can see just how much Outlier outperforms buy and hold on Citibank here. Hey, I want to send you something cool, though, to help you learn how to trade with this, right? It's the free pre-market power-up checklist. I'm going to send this to you 100% free. All you got to do is go over to freetradingdata.com, and I'll send you our free pre-market power-up checklist. So let's take a look over at what the internet has to say about this, right? First Republic failed, and then Republic First failed. Is someone trying to tell us something? This person says, don't forget about One Republic. They haven't failed just yet. This person says, we need to start two banks, Republic, and First, to get to the bottom of this. That's pretty funny. Yes, I believe the message is vote Trump. Interesting. First Republic, first failed, Republic next. I hope not. First Republic didn't fail per se. Rather, the wealthy customer base panicked after what happened in Silicon Valley Bank, fearing balances that exceeded FDIC limits could be lost. Yes, exactly what we're talking about, right? If they lose money on their investments, they can't satisfy the depositors. They can't pay back the depositors. So that's exactly how the bank failed, 100%. Hey, YouTube thinks you're going to love one of these two videos, right? I don't know how the YouTube algorithm works, but it says these are going to be awesome for you to watch today. Thank you so much for tuning in to today's Outlier Live. I'll see you in the next episode.